If you're a UK company director and you're staring at mounting debts, HMRC are chasing you daily and creditors are breathing down your neck, you may feel that insolvency is the only way out. But here's the truth. Before you liquidate a business, there are 6 critical steps you must take. Skip them and you could make the situation 10 times worse. Do them and you could be protecting yourself, your creditors, your family and your future. I know exactly how overwhelming this is. You're ducking calls, you're ignoring letters and you're wondering how on earth are you going to explain this to staff or family. And most directors panic and they rush straight into it. And that's when mistakes happen. This video is about slowing down, taking a breath and preparing properly so you come out the other side with your head up. And in the next 20 minutes, I'm going to walk you through 6 things you must do before insolvency. Number 1, get a clear financial picture. Number 2, make sure that you're not trading irresponsibly. Number 3, organise your records. Number 4, make sure you handle staff and contracts properly. Number 5, review personal guarantees and any overdrawn loan accounts. And number 6, get the right advice and appoint an insolvency practitioner. Now by the end, you're going to know exactly how to prepare step by step so you don't walk into an insolvency blind. So let's talk about step 1. Get a clear financial picture. Now this is the very step before any insolvency, okay? And it's about getting brutally honest about your financial positions. Because many directors, they don't really know the numbers. They're too frightened to look at it. And when the insolvency practitioner steps in, it can look like you've been reckless or hiding things. And that's not where you want to be. So listen, let's go caveman. Make a simple style. You don't have to be a whiz on Excel or computer literate even. But make a simple list of all the company debts. Like literally on a spreadsheet, on a piece of paper, HMRC, VAT, PAYE, corporation tax, call the revenue, open them HMRC letters. You know them brown letters you've been ignoring? Open them. Now you might be getting letters from different departments and it might be a bit confusing as to what you actually owe. So pick the phone up. Maybe speak to your accountant, see if they can log into the gateway where it'll have all the details. And also ask the question, are you up to date with your returns? Are you up to date with all your VAT returns? Are you up to date with all your PAYE? Are you up to date with your latest set of statutory accounts, okay? Ring up your creditors, get up to date statements, okay? Now, then have a look on the other side of what are the assets of the business, okay? Is there any stock? Is there any equipment? Are the vehicles? Are the property? Are the trademarks? Are the websites? How much cash have you got in the bank? How much cash have you got due to come in that is work done? That's debtors. And also, what's your work in progress look like? What does the pipeline look like? And then next thing is a cash flow. What's due out and when? Like a 13-week rolling cash flow is what most business should be using. And all it is, again, is a really basic spreadsheet of what's due to come in and what's due to come out. You know, what are your commitments? Rent, wages, PAYE, energy bills, etc. What you've got due to come in. Are you chasing that money in hard? Because once you've written this down, you're going to see a number of things. 1, how bad the situation really is. And 2, you're going to be ready for when, if you go to an insolvency practitioner and they ask it, you're going to be giving them everything. You're going to be walking in with clarity. And that is a reason, that shows that you're acting responsibly. And it immediately reduces the amount of work the insolvency practitioner has to do to actually get your notices out and speak and inform to creditors. Okay? Now, step 2. You've got to be really careful about continuing to trade if there's no hope of recovery. Because the moment you realise that your company can't pay its debts when they're due, once you realise that your liabilities are more than your assets, your duty as a director changes. You're not going to work now to get money back to shareholders. It is about protecting creditors, okay? If you keep trading recklessly, you risk wrongful trading charges. And that is the type of thing that can get you disqualified, make you personally liable, and actually really damage your reputation. Now, number of things that you shouldn't be doing. If you're insolvent and you believe in your heart of hearts there's no way of you recovering and getting back on a firm financial footing, you've got to stop taking out credit. Do not take out loans if you know you can't repay them, even if people are offering them you. I spoke to a man and wife last week. They are lovely people. They are in so deep, and really they've got to pull the plug. That, like, they need to speak to an insolvency practitioner immediately and make an appointment. But because they've been offered another loan, they want to go again. And I've said, stop. I said, go away, go and have a look, get some realistic cash flows together for me and come back to me. So they did that exercise, and I've said, listen, there's nothing here that makes me think you should take that additional loan, which is personally guaranteed. Sorry, not personally guaranteed, it's going to be charged against the family home. All it's going to do is going to kick the problem down the line, maybe a month or two, okay? Now, another thing you need to be careful of is don't pay one creditor over another. It's called a preference, and it can be clawed back. So, what that means is, let's say you have a number of creditors, and one of the creditors is your pal, and you decide, let's say you owe your pal 50 grand and you've got 60 grand in the account and you're insolvent. Now that 60 grand should be split equally in the hierarchy of the importance of the creditors, okay? So first we'll go to a charge holder, insolvency practitioner's fees, preferential creditors like HMRC, then the rest falls down to unsecured creditors if there's a dividend, and then finally connected parties get money back. Very unlikely with most insolvencies. If you decide to pay your mate back and then go into insolvency, the insolvency practitioner can either go for your mate to get the money back or set it aside and make you personally liable for that money, okay? Be careful. Another thing is selling assets cheaply. It's called a transaction undervalue, and it's another thing that can get reversed. So let's, for argument's sake, say you are insolvent, you are about to appoint an insolvency practitioner, but you have some assets in that business. You might have some vehicles, some vans, some tables and chairs, and you want to sell those assets to a connected company. My coffee machine's going off. It does it every bloody time when we do a video, right? Now, if you want to buy your assets before you appoint an insolvency practitioner, you can do that, but be mindful it's going to be scrutinised by the insolvency practitioner once you appoint them. So this is what you do. You go out there and you get a valuation done off an agent. And you make sure that that agent is given all the information. They come down to site, they see everything. They'll give you a report with an in situ value and an ex situ value. And then you're going to make an offer to that agent, ideally close to the in situ value. And you want the agent to recommend that as a good sale. Basically, that is a fair price. And then, once you appoint the insolvency practitioner, you can show them that you've had your assets independently valued and you have a letter of recommendation from a credible agent who has agreed that you've paid a fair market value. And then either you'll have paid the money into your bank account or you will be getting some terms to pay the insolvency practitioner over a period of time, okay? So, if you're insolvent, I'm not saying that you have to lock the doors immediately, okay? You can take reasonable steps to protect company assets, complete work in progress, but every decision that you're making now has to have one question in mind. Does this decision Is it in the best interest of creditors, or does it make their positions worse? If you're going to do a job to bring more money into the pot for creditors, that is a good thing. You will not be criticised for it. If you are thinking of paying a supplier because the supplier will deliver some goods to site, you will complete some work and get more money back into the pot, that is a decision that should be accepted. You're doing it in the creditor's interests. Be careful. Listen, at this stage, guys, if anything I've said is like pricked a bone with you, go and put your details into the assessment at the top of the description. One of my team will call you today. No obligation, no strings. We'll talk you through what's going on and what your options are. Right, step 3. Get organised. Organise your books and records, because when an insolvency practitioner gets appointed, they're going to look at your records, okay? If they're missing, if they're messy, if they're incomplete, it does raise red flags about your conduct. And that is when they're going to investigate your conduct, whatever goes on. But if you've got loads of missing bits of information, there's going to be more stress on you personally, more work to do for you personally, and the chance of disqualification is higher. So, these are some of the things you're going to want. Bank statements. Let's get your last 3 years bank statements ready. Ideally, get some up-to-date management accounts. Please, please, please. Get a bookkeeper in, guys. If you just like our content, one of the biggest tips that I can give you is you need to be having management accounts every month. A profit and loss and a balance sheet. And if you can't do it, you can't use Xero, you can't use Sage, you can't use QuickBooks, that's fine, but get someone in who can. Because if you ever end up in insolvency, having that monthly accurate management information is critical, okay? Ideally, get all your returns up to date, VAT, PAYE, company accounts. Make sure you have all your employee contracts ready and the payroll records, because you want to make sure when they're making a claim for redundancy, it's a quick process. Have your copies of leases, loan agreements, and any contracts that the business has. And again, the benefits of this is, if you're well prepared, I believe it shows that you've taken your duties seriously. You might be insolvent, okay? But if you're going to the insolvency practitioner with all your books and records, it helps them wrap things up faster. And it's one of the best ways to show that you are trying to act responsibly. So, number 4, handling staff and other contracts. So, employees are probably the most worried group when insolvency looms. You know, you're probably worried how they're going to be paid. They're going to be worried about the jobs. And obviously every situation is different, but when the decision's been made, it's good to be upfront, okay? Don't promise jobs if you know they're not safe. Like in insolvency, staff are made redundant, but they can claim unpaid wages, holiday pay, redundancy pay for those that have been there over 2 years, and even notice pay in lieu of you not giving them proper notice. And it's through the redundancy payment service. And your role is to make sure the records are accurate so the claims go through smoothly, okay? Now, another thing you want to be checking is contracts, like contracts with landlords, contracts with suppliers, contracts with customers. Now, is there any work that's been paid for that needs to be done that can be done, okay? Will that work that you've been contracted to do bring more money in the pot to creditors? And please, please, when you're checking your leases, check for personal guarantees, okay? Your landlord may have asked you to sign a personal guarantee on your lease originally, and there might not just be a personal guarantee on the rent, there might be a personal guarantee on something called dilapidations. And dilapidations essentially is when you leave a business premises, you have got to put the premises back to the same condition as when you moved in. Now this can be a real issue for directors. I have seen dilapidations claimed in the tens of thousands of pounds that in my eyes aren't warranted, so be careful, okay? Now, step 5, this is a biggie. You've got to review personal guarantees and directors' loan accounts, okay? Now, most directors don't realise until it's too late, that the insolvency triggers the personal guarantee, right? If you've signed a PG on a loan, on an overdraft, on a lease, on a supplier, once the company goes into liquidation, the creditor's going to serve notice on you, okay? They're going to chase you personally. Now, before you do any of this, it's important that you get a clear list of every PG that you've signed so you know what's coming. Now, once you've got that information, okay, you've got a clear understanding of what's about to hit you once you go into insolvency. And it's at that stage you can start to get prepared personally, okay? Now the good news is most personally guaranteed debts can either be negotiated over a longer period of time, especially if you've signed PGs with like Funding Circle, Capital on Tap, iWalker. Obviously, these are lenders that want their money back, but as long as you go to them with a decent proposal of how you're going to repay that money, even if it's over a longer period of time, it's highly likely they'll accept it. With some lenders and some suppliers, what you can offer is full and final settlements, where you might owe this much, but you're willing to... I'll tell you the personal story, right? Me and my mate, when I had to go through insolvency, we owed a bank 25 grand on an overdraft, right? He was obviously better advised than me at the time, because he went to the bank and said, listen, I'm willing to offer you 2.5 grand full and final. And they took it. And they bloody came to me for the rest of it, right? So banks will accept full and final settlements. It's all about your personal situation, guys. If you're in £1 million pad with no mortgage, it's going to be harder to get a discount done. I've done podcasts with a chap called Gary Whitehead. Please go and have a look at that around PGs. It will really help you. And if you want an introduction to Gary to discuss your personal guarantees as a result of an insolvency, I can do that. The key thing is you can start to get a plan in place before you make any decisions, okay? Now, here's a biggie. I'm getting criticised heavily for this on LinkedIn right now. And it's overdrawn directors' loan accounts. If you have borrowed money from the company that hasn't been repaid, the insolvency practitioner sees it as an asset. They will chase you personally. And overdrawn loan accounts are one of the biggest ways directors lose their homes, and they can be made bankrupt, okay? Now this is what I want you to do. You should, as a director, have an up-to-date line in your accounts software somewhere so you understand where your director's loan account sits. That's part of your fiduciary duties. The reality is a lot of you don't, okay? Now, it's really important for you to understand, A, do you have an overdrawn loan account? This is where you'll find it, in your management accounts. Go on to Xero, QuickBooks, Sage, Free Agent, any others that you're using, and hit trial balance, okay? Or a balance sheet. That will show you if you have an overdrawn loan account that it is in credit or overdrawn, okay? If you don't have that, sadly, you're going to have to go to your last set of accounts, which is just a snapshot of your company on a day in the past. But in the assets or debtors section, or it will say directors advances, it will show if you have an overdrawn loan account or not. Now, if you're going back in time to look at it, that is not the full picture, because everything that you have taken since those last set of accounts that you might think is a dividend, okay? If your company's insolvent, you're not allowed to take a dividend. Potentially, anything that you've taken out of the business that is not salary through the payroll could get reclassified to an overdrawn director's loan account, okay? Which you could be made to pay back. So what's my advice around this? Please, if you're not insolvent yet, you just like watching our videos, get a bloody bookkeeper, or make sure your accountant does up-to-date monthly management accounts. If you are in the situation where you're hurtling to insolvency, or you are about to appoint a liquidator, or even you're dealing with us, it's important that you understand your overdrawn loan account, because then you can go to the insolvency practitioner fully armed and say to them, listen, this is my position, okay? Because they're going to ask you to pay it back. Now, there are times, in most cases, an insolvency practitioner has the discretion to get a deal done with you before you decide to, in principle, right? They can give you guidance. So as long as you are open and transparent at the start, they're meant to give you some pre-appointment advice, okay, around DLAs. Some of them will be really nervous about nailing the colours to the mask on a settlement before you appoint them. But if you show them everything, show them your assets and liabilities, income and expenditure, they should be able to give you a guide. Because if you are somebody that has equity in your property, if you have personal wealth, this is a real problem for you because you might be able to afford to pay it all back. Now, the reason why you can get a discount done in most cases and negotiated terms is as long as the insolvency practitioner is bringing more into the insolvency than a bankruptcy, and bankruptcy has a lot of risk for an insolvency practitioner and it's very costly, the chances are you'll be able to get a deal accepted. If you want some help with a director's loan account, this is the time to pick the phone up. And when I say help, if you want some advice on how you should be handling it and help you get clarity on what the problem is and what your options might be by way of negotiation, this is a time to actually hit that assessment link in the description and get in touch with us, okay? Because knowing where you stand means you can get better advice from the insolvency practitioner and actually have a plan before you appoint them, okay? So, step 6, get the right advice. Choose the right insolvency practitioner, because every insolvency has to be overseen by a licensed insolvency practitioner. Now their role, once you appoint them, they're not there to work for you. They are duty bound to act in the best interest of creditors, okay? Now you want to choose a firm who you can communicate to, who you can talk to, someone who explains the process in plain English. Someone who answers your questions honestly, not dodges them like a politician, okay? You want someone who can advise you on some of the risks, like overdrawn loan accounts, how they're going to be handled post-insolvency, and someone who's willing to put some effort in pre-appointment before you pay any money, right? Not every firm is the same, okay? If you choose the right one, it's generally a better outcome. It's a smoother process. So how do you look for a good firm? Listen, maybe you speak to us, click the link below. But if you don't like us, that's okay. Go and review people on Trustpilot. Go and look at Google reviews. Go and read their websites. Go and have a look at the content they're putting out there. Go and speak to a few. Go and sit down with them. If there's an overdrawn loan account, be really open with them. How would you handle this if we decided to appoint you? Okay? Now, before you appoint anyone, make sure you get your numbers straight. Do not trade on if it's going to be to the detriment of creditors. Get organised. Make sure your staff are informed. Review your PGs and your DLA position. And get the right advice and choose the right firm. Because if you do these things, I believe you're protecting yourself, you're reducing stress, and you can go into insolvency in a controlled manner. I'm not saying it changes the outcome, but if you are forewarned about what's going to happen in the future, you're going to sleep better. If you're a UK director facing insolvency, contact us at Director First. We're going to guide you step by step. We're going to explain risks and we're going to make sure you don't fall into any traps that are going to really hurt you down the line. Subscribe now for more plain English insolvency guides. And if you're looking for more videos on how to close a company, I want you to go there and click on that playlist. And it's going to tell you about your options when your business is insolvent. It's going to give you a quick guide to director insolvency. Thank you for your time. Chris Worden, Director First.